Hi everyone. Today we are going to discuss about day 2. So if you have an assurance role for day 2, the audit AOs are required to be written in a certain depth. So if you see the past CFE pattern, you will observe that there are some repetitive AOs that keep coming as part of the assurance AOs. So the main four are usually in the audit planning memo, you have to do the audit risk assessment, then the materiality, audit approach, and then there are control weaknesses, and you will have to write audit procedures. Usually materiality and approach would be combined in one AO, or sometimes it could be separate, but these four AOs would keep repeatedly coming. So there is I'm going to explain you a certain tips and tricks to you, which would help you to score a C or CD in these four AOs, that would help you to clear day 2. So today we are going to discuss about audit risk. So let me share. Okay. So as you can see, here are the audit risk factors that are usually given in the case narration everywhere. So what I have done is I have identified the categories. Then it is important to state what is the risk. Now this you will have to state using the case facts. So use the case facts given in the case to define what is the risk. The another portion is why is it a risk. So it's not just sufficient to mention that what is the risk, but you have to explain why it is a risk and the result, that what happens, so it increases the risk or decreases the risk. Usually CPA follows a format of like if you see in the solution guides, they would follow format of risk, then factors increasing risk, and then factors decreasing risk. And in that there are several categories that keep repeating as a risk factor. So we will go one by one to see what it means. So usually there would be a case fact related to accounting staff. Okay, so either the controller has gone and on a mat leave, the CFO has resigned, or a new controller had joined. Something you would pick up from the case fact. So whenever you are reading, like keep it in mind that this is going to affect your audit risk. Now there would be usually a period given, say the controller left in September. So up to January to August, the controls were good. And after September, the control environment was weak. So you have to state that because there was no one overseeing the work of the staff, then that's why there was the weak control environment, and there is a possibility of errors and misstatements. So the RRM goes high, and that is why it increases the audit risk. Similarly, from your financial reporting, the second point is from your financial reporting errors, financial reporting AOs, you must have identified some errors. So club them here, saying that, okay, these were the identified errors, and there is a possibility that there could be other unidentified errors as well. That is why it increases the risk. The next factor is the control environment. Like again, the case fact would be given to you. This is similar to the first one, but it's just there is no change in the team as such, but the there would be some factors that would suggest that the staff is overworked, there is no audit committee, there is no one who usually supervises is not there. So that increases the risk of fraud. So the important point, what I'm trying to say here is, it is important to write all these three, like you can write it in three sentences. What is the risk? Use the case fact. Why it is a risk? Explain the risk. What goes wrong if that factor is missing, and then conclude like what that means. So it increases the risk or what happens. Then there is another important one that you would observe in the case scenarios is the management bias. So whenever there are loan covenants, so keep an eye for loan covenants, bonus arrangements that are based on profits, then there are poor economic conditions and the share price is getting affected. So all these factors that that give management a chance to either overstate the revenue, or some, if the covenants are based on say inventory, accounts receivable, so they're prone to overstate those accounts. So that increases the inherent risk of management bias, and management bias is to inflate the results to improve the profit, and which affects the share price as well. So that increases the risk. Then the next set is new controls or processes that are introduced. So like they're changing their point of sale system, or they acquired a new company and they got the software of that new company integrated with your original company. So you know that again changes is the processes that are existing within your environment as well. So it also introduces new controls processes in the accounting environment, and there is a chance that there are some unidentified misstatements because you don't know how that works yet, whether it is linking to the correct GL accounts, whether it is going to hitting the C's, like specified accounts which it is supposed to. So you don't know that. That is why there are chances of misstatements, and then it increases the risk. Next big one is going concern. So if not every time there is a covenant breach, so you will have to again look for the case facts. But sometimes with the covenant, you are given the covenant calculation, and in the calculation if you find out that your covenant is offside on one element or something like that, then there is a risk that the loan would be recalled by the bank, and if it's a large amount that the company cannot pay, so it may affect the going concern. So now you have to explain that why we are saying that the covenant breach would be such a big risk. And then as you know, if it's a going concern, then you have to prepare the financial statements with the going concern assumption. So there is a risk that the financial statements are not prepared with the going concern assumption. So that explain all three parts of the risk. Then significant management judgment or estimates. So if there is an asset retirement obligation or a new loyalty program that is launched, which is not yet established, and management has given an estimate, but it is dependent on their judgment. So if the amount is big, and it would be material, if anything changes, then it is going to affect your financial statements. So it increases the risk. And then there are changes in accounting framework or some complex accounting transactions. So as you're going through your financial reporting AOs in the first section, you will observe these some points. So there could be a first time audit. If it's a first time audit, there is no assurance on the opening balances. So you have to state that there may be a misstatement in the opening balances. We have to obtain assurance on the opening balances. If inventory is a large portion of their financial statements, then check how you could get an a comment on that inventory opening balances may be incorrect, so need to get an assurance over the opening balances. So based on, so you will see that these are six, seven, eight factors or eight categories, I would say. And the case facts would be integrated, which would fall within these eight categories. So if you prepare it ahead of time, like a format or something like that, it becomes easier to attempt that AO in quick and fastest manner possible during the exam scenario, so that you're not wasting too much time. And to score C, there is another element of this, is that factors decreasing the risk. So you just don't state that okay, all these factors are increasing the risk. Identify the factors that are decreasing the risk. So what are those usually factors? So in a day two scenario, you will see that usually there are 5 to 6 factors that are increasing the risk and 2 to 3 factors that are decreasing the risk. So try to mention at least 2 points in the factors decreasing the risk. Usually they fall into the strong control environment, like there is a very strong internal control in the various retail locations where the processes are very standardized, and it reduces the chances of the error or fraud being committed, and it is a very effective control environment. And then again, so right, the so what, so it reduces the risk. Then another example of strong control environment is the board of director is very active, or the owner manager who is the majority shareholder, he or she is very active and like very much involved in the business, so they provide insight and sets the positive tone. Then if it's a long-term client, then it's a known environment for audit. So from a CPA's perspective, you know what are their control weaknesses, how the entity performs. So you have a better understanding of that business, so it reduces the risk. And then again, the similar internal control processes. So based on case facts, you try to identify where it fits, and then explain what is the risk, why is the risk, so what happens. It is very important, I'm stressing it again, it is very important to cover these 3 areas: what is the risk, why it is a risk, and what happens. Because if you just state the case fact, you will be held back at RC because you're not completing your thought. Like CPA way of learning, you will always see that so what, so why, what. So always keep that in mind. Okay, this is the case fact, why it is a risk, and so what happens. So if you cover 5 to 6 factors that are increasing the risk, then 1 or 2 factors which are decreasing the risk, and then you move on to the conclusion. Okay, now we have listed all the factors, but while concluding, try to weigh in like what you see from the case fact is the important factor. That if it keeps coming repeatedly, that controller were not there, supervision was not there, control was not there because during that period. So weigh in on the highest risk that is affecting the overall financial statement. And then you can conclude in one line that due to absence of the controller and lack of oversight on the accounting staff, the overall financial statement is assessed as high. Now, sometimes you will be given an audit planning memo that was already drafted in, say, previous round of audit. So in that case, then revisit it, that previously it was assessed as medium, but based on the changes and the recent events, it is now assessed as high. So always remember that if a previous audit memo reference is given, like relate to it, that okay, it was, just don't conclude based on your analysis you are assessing the risk as high. Always comment that okay, it was assessed as low or medium, but due to these changes I'm revising the risk assessment as high. Okay, so some more do's, as I mentioned, always mention 4 to 5 factors that are increasing the risk, mention 1 or 2 factors that are decreasing the risk, then comment on the risk factor from the overall financial level. So what usually happens is in the financial reporting AOs, you find out, okay, the ARO is not correct or the revenue is not booked correct. So don't mention that, okay, this was the error. So it shouldn't be one specific area of error. It should be based on the impact on the overall financial statement, what is happening. So you can comment that there were several errors that were identified in these areas. So it increases the risk of material misstatement and some other unidentified areas in the overall financial statement. So don't comment on one specific area. Keep it at the OFSL level. Then always weigh in what is the biggest concern, like I told you for conclusion. So what is the biggest concern of all, and then conclude on the risk assessment, link it to the previous audit memo. Then for day two, what I used to do is, like, when you're going through your first reading, whenever you identify the risk factors, I used to immediate start writing the risk AO, so that within that first hour of reading, by the time I'm near my reading, I have already completed 70 to 80% of this AO. Only the financial reporting AOs that you would solve, and then you would take the points or the errors or risk factors from there. Only those I used to leave blank, that as per the financial reporting errors identified, and then you can fill in the blanks. But almost all other factors, like the controller or the management bias, covenant, all those you would find it out in your first reading. So it becomes easier that your one AO is done alongside your reading. Now it's a personal preference. Some people like just want to go through, and they don't like to write simultaneously while they are reading. But I prefer it I preferred it this way, because, like, instead of flipping through the pages and going back and forth, it was easier to just note down the points, and then you can elaborate when you come to that AO part. So if you see the feedback guide for any assurance day 2 audit risk AO, you will find that what is required, this is what is required. What in the do's section, what I have mentioned is what is required. So there should be 4 to 5 factors that are increasing the risk. Second, there should be 1 or 2 factors that are decreasing the risk. Conclude on the overall risk assessment. And very important point is these three three sentences: that what is the risk with the case fact, why it is a risk, and so what happens. So this is a very repetitive AO, which could easily give you a score of C or CD. If you cover all the AOs, it goes to CD. Sorry, all the risk factors, it goes to CD. So hopefully this will help you in your preparation for day 2 audit AOs. In the next video, we would see how to write the materiality AO. Thank you.